Hi everyone, my name is Loutsenko, founder and CEO of OVOM Research. Happy Sunday, first and foremost. So I wanted to make one, really brief video, just specifically to talk about the equity market. And a lot of videos, well, a few videos that I've done in the past have mostly been geared towards kind of like a longer term view of the equity market. Just because the way that uh, the style that I use to kind of analyze the equity market is from a macro perspective. Um, but with that being said, I wanted to share some of my short-term views as it relates to the broader U.S. equity market, and that's really because I think we might be nearing an inflection point that I think might come sooner than um, even the kind of the most bearish people on equities may think. So, without further ado, let me share my screen. So just starting off with the 24 to 2024 year-to-date performance of the major U.S. equity market indices. So really no surprises here. Mega cap tech and big growth are leading the charge with the Nasdaq 100 and S&P 500. Um, with the equal weighted S&P 500, Dow, value stocks, and Russell 2000 small caps not lagging. They're very, modestly up year to date, but the story has been the Nasdaq 100 and the S&P 500 large caps, just like in 2023. So, starting to dig a little bit beneath the surface. So, this is the S&P 500 composite year-to-date performance with all 11 market segments. So, this is where we start to kind of see the potential concentration issues that I've spoken about how I perceive them as significant market risks in the long term. But really, like I said, this brief video is about the short term. So here I just wanted to highlight that besides infotech and communications, which carry Apple, Microsoft, Nvidia, and then communications carries Google Class A and C shares, as well as Meta, which represent the AI story. All other 9 of 11 segments are underperforming the S&P 500 year to date. So digging a little bit deeper below the surface. So like I said, the Magnificent Seven, as many know, have been leading large caps in both the Nasdaq 100 and S&P 500 at borderline unprecedented levels. So, here we could see that now Microsoft's recently went above the S&P 500 composite. Before then, you had Microsoft, Apple, and Tesla underperforming, which led many to start calling the Magnificent Seven the Fabulous Four. But in any case, these are the infamous stocks that are outperforming for the most part. the S&P 500, or they were in 2023, and they're keeping the market weighted index doing really well, especially relative to history. But I think as you'll see in the later part of my um, uh, slideshow here, um, not only has that already begun fading, but in terms of Magnificent Seven, but for a lot of, and I mean a lot of households S&P 500 names, it's already begun long ago. But sticking on topic with tech in the Mag 7. So here we have the top 10 mega caps as a share of the total S&P 500 index. So what this means is the green pie in the pie chart at 35.05%. That represents how much the top 10 mega caps, um, uh, not sure if there's a better way to word to phrase it, but that's how much of the market cap weighted S&P 500 they technically own. So the performance of those top 10 mega caps contributes over 1/3 to the total S&P 500 components, as the remaining 490 largest US large caps. So, if you let that sink in, that really is, a very, very staggering number in terms of market concentration. And just elaborating a little bit more at the individual Mag 7 level. So there are actually two things that I think are really, really quite something that I wanted to highlight in this chart. Excuse me. So first and foremost, we have the Magnificent Seven: Apple, Amazon, Meta, Google, Microsoft, Nvidia, and Tesla. Cumulatively, year to date, they contributed 9.6% to the S&P 500 composite, while the remaining 493 contributed 5.4%. So, breaking that down into simple terms, the Mag 7 contributed basically double the remaining 493 components. And, just off the top of my head, we're talking about names like Berkshire Hathaway, Eli Lilly, which has had an incredible streak. And that's actually a stock I want to talk a lot more about in future videos. But yeah, if you look at this performance as from the perspective of concentrated contribution, it really is something. And the second thing, I'm not sure how many people will realize this, but if you look at Nvidia and then Apple, Amazon, Meta, Google, Microsoft, and Tesla, X Nvidia, the rest of the magnificent, six, we'll call them for now, without Nvidia, cumulatively, they account for less contribution to the S&P 500 than Nvidia. So if you added Apple, Amazon, Meta, Google, Class A and Class A and C shares, Microsoft, and Tesla, you would still be left with a smaller contribution by, I think, about 0.5% to the S&P 500 composite year to date than Nvidia alone. So again, when you talk about market concentration, and I've heard some people in financial media talk about how that's not an issue. The data kind of begs to differ. So I just wanted to go over two quick slides from a valuation perspective as it relates to the Mag 7 and broader large caps in the S&P 500. Especially because another talking point I've heard is that, the performance we're seeing and interest we're seeing in the Mag 7 is completely justified because the valuations are justified. And so this chart represents the S&P 500 grouped by market cap rank. So the top, so you have them bunched in 50s. So the top 50 by market cap in the S&P 500 have a median. Oh, sorry, and they're also the valuation metric uses median price to sales on the basket of 50. So the top 50 have a median price to sales of 5.6, um, which is not cheap by any stretch of the imagination. And then the bottom 50 for 51 to 500 have a median price sales of 1.6, 1.6x, which, obviously is much better valuation. And of course, growth rates and things like that play into it. But, if you look at just those two groupings, the median price of sales of the top 50 is 3.5 times the lowest in the S&P 500. And again, you have to remember that we're talking about the 500, either largest, most significant U.S. large cap public equities. So that's a significant difference. And I think it debunks the narrative that the Magnificent Seven are, comparatively better priced than the rest of the market. I just have one more valuation slide I actually thought was the most interesting. So this this uses the 12-month forward PE, and it looks at three different categories in the S&P 500. So the red bar and over 5-year intervals dating back to 1990. So the red bar is the top 10 mega caps. The orange is the S&P 500 minus those 10, so the bottom 490. And then the blue is just the S&P 500 composite. Fascinatingly, if you look at the years below, today's market is more expensive both from a top 10 mega cap perspective, the remaining 490 and S&P 500. Again, from the perspective of 12-month forward price to earnings ratio, than the peak reached in the 2000 tech bust. So, I'm sure some will disagree with this, just because of the bullish nature of the majority of equity market participants. But this is a very, very widely accepted valuation metric, and you could double check my calculations, but I'm pretty confident in them. And again, the really what I think is an amazing takeaway here is the market, at least from a quantitative perspective, is more expensive than preceding the 2000s tech bust. And I think that's really saying a lot. So just, I believe, two final slides here. This one I'll just go quickly through. So whether you look at it at a weekly basis, this is just the performance of the S&P 500 and 11 market segments this past week in June, the third week. No surprise, tech leading the way. Actually, it looks like consumer discretionary at the very, very last moment on Friday ticked above the S&P 500 average. But, again, whether you look at year to date, 1 year, 5-year intervals, weekly, not every week, sorry, but you'll get a very similar storyline with respect to market leadership. It's been tech, um, the whole way for quite some time. Um, and This is just the last slide, but which I'll finish out with. But first, I want to briefly touch on why that's concerning. Um, Really, for two reasons. So everyone knows the expression. There's always a good reason to perhaps be a little cautious when the generals are leading and the soldiers aren't following. To be fair, we've seen that for a number of years now. So that nomenclature is getting a little old. But my concern right now with mega cap tech and high growth speculative tech is that not only are the generals leading and the soldiers aren't following, but as we saw in the Mag 7 year-to-date performance, even some of the generals are starting to abandon. So if we're left with a market that's essentially Nvidia, and as speaking of Nvidia, you have a lot of semi names that were initially trading alongside Nvidia's move up. They're starting to also fade. So companies like ON Semi, Etsy's down like 91% from their peak, something crazy. Uh, Again, until recently, Microsoft was underperforming. Apple's still underperforming, even with that big, AI announcement. So if the market leadership is gonna dwindle from led by tech to led by AI to led by Nvidia, you have to think about what's going to happen when inevitably Nvidia has a poor earnings quarter, and that's a best case scenario because every S&P 500 component has missed. I don't know this for a fact, but I mean, I think it's safe to say every big name S&P 500 component has had a disappointing earnings or revenue quarter. So, um, if that happens, um, I'll be interested to see what the sell-off would be like because we've never had a $3.4 trillion market cap company, but at the same time, from my perspective, it is grossly overvalued. But that being said, finishing with the last slide, like I often talk about, uh, issues within the broader S&P 500 are being masked by mega caps, and these are just a few examples of 2024 year-to-date performance of household names that have been suffering greatly. Boeing maybe not the best example because of the PR issues, but still we have Starbucks, we have Kraft Heinz, Starbucks down 13.5%. Carnival Cruise Lines, which had an unbelievable run, down 7%. Nike down 8.5%. Accenture down 11%. Kraft Heinz down 11.5%. Uh, McDonald's down almost 12%. Um, and these are just seven. I really could have gone on and on here. Like I said, Etsy's having a horrible year. Owen Semi, really the list goes on and on. So I guess what I'd close this video with is we are seeing the major market cap weighted indexes continue to rise, but we are not seeing that those higher highs supported by components within that index also covering new highs. Instead, we're getting higher highs from lower lows in terms of the equities that comprise the index. And that's, for anyone who knows technical analysis or even just, market dynamics knows that that's, a um, pretty classic sign that the market's due for a correction at bare minimum. And, I've done, like I said, I've done a few macro videos now where, people who follow me know that I have a much more kind of skeptical view of the Fed of the situation with the Fed and the economic situation will impact the equity market. But even just from a bottom up fundamental perspective, um, I see really an incredible amount of danger in market risk with such concentration and such enormous market caps that we've never seen, and at historically high valuations to boot. Um, so yeah, that's all I had. Hope you enjoyed the video. And again, I'm not saying the market's gonna peak this month, this quarter, but yeah, I do think that we're closer than consensus is leading us to believe. In short. All right. Thanks again and happy Sunday.